We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible.
What's wrong with him?
My first thought would be a lot.
All right. Today is Sunday, August 8th. This is a recap for the stock market activities last week, an outlook for the week to come. And just a spoiler alert, it's going to be a bloodbath. So grab your popcorn and grab your protections with you. Folks, before we start, a word of thank you to the viewers of this channel for 10,000 subscribers. Now, back in the day, I would stand in the street corner and I would yell and scream at the top of my lungs. I'd be lucky if I have 3 homeless people listening to me. And now look at that, we got 10,000 people listening. And the biggest gain came from the country of Sweden, of all countries. All of a sudden I got Swedish people listening to me. Folks, just a heads up, this is an overrated channel. And in the long term, you're gonna lose money listening to me. Anyways, the majority of the gains came off a video I made titled "The Fed is Committing the Crime of the Century" by conducting the greatest financial experiment in history, which will lead to a disaster, and this disaster will impact the poor disproportionately. And we will continue to speak the truth about the Federal Reserve in this channel every single day. Unless I get caught and severely beaten in a bunker somewhere, I will continue to speak the truth in this channel. With that being said, in focus tonight, what else? The blockbuster jobs report that we got on Friday for the month of July. And here it is. 943,000 jobs created in the month of July. Wow, the economy is firing on all cylinders. The economy is growing like never before, right? Well, hold your horses there. On paper, this number is well done. The cooks gave us a hot one, and we are only short 5.7 million jobs since the start of the pandemic. We all know that not all of these jobs will be recovered because a lot of people went into retirement, and a lot of other people are doing something else entirely different. A lot of moms are staying at home, etc., etc. So the expectations are we're not going to recover all of the jobs that we lost pre-pandemic. The question is, can we create new ones? That will be growth. But recovering the old jobs that we have lost, this is called a recovery, not growth. Very, very important thing to distinguish. The headline numbers from the July 2021 jobs report showed the U.S. economy added 943,000 jobs last month, and the unemployment rate fell sharply from 5.9% to 5.4%. And here it is, the 1-month net change in jobs for the month of July. The majority of jobs created were in the leisure and hospitality sectors of the economy, in addition to the government sector, meaning that what we're doing right now is a mere recovery of the jobs we lost in the pandemic. As economies reopen due to the vaccination progress in the country, we are recovering these jobs we lost last year, specifically in the leisure and hospitality sector of the market. We have a lot of fiscal spending, of course. With all the bureaucracy, no wonder why the government is creating more jobs. But looking at this, does this look as an economy that is growing and expanding, or an economy that is recovering? Well, if you have a growing economy, in expansion mode, you'll create jobs in retail, in mining, construction, information. Well, we have created some jobs in July in these sectors of the market, the offensive, expansionary sectors of the economy, but not by much. Not impressive at all. Now, remember this. The Federal Reserve says we're not going to taper, we're not going to adjust our monetary policy until we achieve 2 things, price stability and full employment. Well, after trillions and trillions of dollars in the cocaine operation of propping up the market and the economy via quantitative easing, specifically this time around, trillions and trillions and trillions of dollars. And this is all what we're getting right now, recovering jobs in leisure and hospitality. Where is the growth, Mr. Powell? But anyhow, the number is hot, hot, hot on paper, and this will trigger tapering fears. You're already seeing it in the market. You saw the reaction in the bond market on Friday, the reaction of the US dollar on Friday, and the reaction of gold as we speak right now, crashing. And the reason is the Fed said pay no attention to inflation as a barometer for tapering because inflation will be transitory. Pay attention to the employment reports. If they come out hot, that will put us closer to tapering. But wait. There is more. There is a catch. We'll talk about it in a second. But first, let's get more details from the same employment report. What about the weekly earnings in America? And by the way, I'm building to the point of tapering from the Fed, so pay attention here. We have a massive wage gap between men and women across all ethnicities. The highest paid ethnicity is Asians, followed by white, and then black, and lastly, Hispanics. It's a draw, but again, both lagging whites and Asians. Now, this wage gap between men and women is terrible. When you look at this, there is a wage gap between men and women across all ethnicities. And they continue to talk about men being paid more than women, and I'm like, what men? We're starving over here. Perhaps what's causing the distortion is the inclusion of the lizard community within men. We're talking about executives and quote-unquote corporate leaders who happen to be lizards, not human beings, but the majority of them are male lizards. Perhaps that tilts the wage gap a little higher, but if you remove the lizard population out of men, perhaps the wage gap shrinks a little, but either way, it is horrible, and it has to be fixed and addressed. And that leads me, why are we talking about gender and ethnicities, by the way? Because remember what Fed Jerome Powell said in the last press conference when, surprise, surprise, Steve Leisman of all people asked the real question. Let's hear the exchange once again.
Thank you very much. Mr. Chairman, I wonder if you might be able to put some, I don't know, numbers or maybe more detail around this concept of substantial further progress. What counts as the progress numerically, if you will, or citing data, if you could, that you cited in the statement today? And if you could be more specific about what substantial further progress would look like, and if that would then lead you to an announcement of an actual reduction in the purchases of your assets. Thank you.
And let's stop here for a second because these lizards speak a different language sometimes, and it's hard to understand. What Leisman is asking is, hey, Jerome, you said you're not going to taper until further substantial progress. Well, what the does that mean? Can you give me something tangible I can work with? A threshold, a numerical threshold, for example? And here is Powell's answer. Spoiler alert, he's going to be vague as and he's going to weasel his way around not to answer the question, but pay attention here.
Great, thank you. So, more detail on substantial further progress. So, let's talk about the maximum employment part of that. As you know, with maximum employment, unlike with price stability, where we can target a number 2%, on average, with maximum employment, there isn't a single number that we can target. We monitor a broad range of data about different aspects of the labor market. There's unemployment among different age groups and such. There's participation. There's wages. There's all kinds of flow data, and we look at all of it to try to arrive at a picture of what is maximum employment. So there isn't. I can't give you a set of numbers, for example, a numerical threshold like we used for a time back in 2012, I guess it was. We didn't do that here. What we said was substantial further progress toward our goals, and what we said was we would keep, effectively, we would give advance warning as we and more and more clarity as we move forward. And that's what we're going to try to do. So, what would substantial further progress be? I'd say we have some ground to cover on the labor market side. I think we're we're some way away from having had substantial further progress with toward the maximum employment goal. I would want to see some strong job numbers, and that's kind of the idea.
So in essence, Powell says, you know, this whole full employment thing we keep talking about when we talk about tapering, it's a flexible situation that keeps fluctuating back and forth. And it's really hard to give you a specific answer or a numerical threshold for what full employment means, because somebody could argue that the unemployment rate falling below 5% is reaching full employment rate. Somebody else will look at it as 2.5% unemployment rate. But by the way, we can also look at the details and look at the different ages and ethnicities and genders and use that as a barometer. In other words, did we say inflation rising above 2% as an average will trigger tapering? Forget about it. We're actually going to look at employment reports. Until and unless we get hot jobs reports, we're not going to taper. Well, now we got a hot jobs report. But, what is hot even means? This is what Powell's saying. You could perceive this as a hot report, but I could receive it as a cold one. For you, it tastes well done. For me, it tastes medium rare. And here it is. Unemployment rate falls for every group, but it is higher for Black and Hispanic workers. Ta-da! You fools. Did you think we're going to taper because we got a hot employment report? Well, what about Black and Hispanic unemployment rates? You see, we're going to wait for those to come down, and then we're going to taper. Let's get the facts. U.S. labor force participation rates. Hispanics down from the pre-pandemic highs. Whites down. Black down. Matter of fact, Black labor force participation rate is curling downward. We're making less progress in the Black U.S. labor force participation rate. The only ethnicity that managed to recover the pre-pandemic highs in terms of participation rate in the labor force is Asians. Furthermore, when we look at the unemployment rates among different ethnicities, whites at 4.8%, Asian 5.3%, Hispanic 6.6%, Black 8.2%. So all shades in the ice cream shop are trending downward, and this is good for the economy. Unemployment is going down. But what if Powell says, you know what, my threshold of tapering when it comes to quote-unquote full employment is the unemployment rate among Blacks to go down? How low should it go before we start tapering? Well, what about the all-time low for Black unemployment, which was 6.6% in 2018. Perhaps we're waiting for that one before we start tapering. You see? You morons. You thought that we're going to taper because we got a hot jobs report. Think again. And of course, when the Black unemployment rate goes down to 6.6% once again, and we ask Mr. Powell, well, you reached your own threshold of tapering. Are you going to taper now, Mr. Powell? He's going to say, we might have recovered the unemployment rate among Blacks, but what about Martians? What about the Uranus people? I gotta wait for their unemployment rates to go down before I start tapering. In other words, ladies and gentlemen, when he says further substantial progress or further substantial whatever the what he means is I'm not gonna taper until I get the order from my overlords over at Wall Street. And by the way, we're gonna meet in Jackson Hole pretty soon. And if they say it's time to taper because those bums, we have to pay them more now with this inflation, you know, their wages are going higher. You gotta taper right now, Mr. Powell. Then he's gonna taper. And by the way, what is the risk of not tapering right now and keeping this baby rolling for as long as possible until we recover the Martian unemployment rate? Here's a guy on Twitter, he calls himself the Maverick of Wall Street. What a fool. And he tweeted this. He said today's blockbuster jobs report, medium well to well done, is an indicator that the pace of economic recovery and inflation is still intact. My prediction is this report is the peak. We will see less jobs created in the next few months while inflation continues to rise. The Fed will realize in the next few months that their printing policy was not behind recovering all of these jobs, but it was the reopening of the economy instead. In fact, by that point, signs of stagflation will become more evident if the Fed doesn't start tapering now. What does this fool means by this tweet? He means this. The Fed is assuming that their policy is responsible in recovering and quote-unquote creating those jobs. Well, we know we're not creating shit. We're just recovering.
Sorry, I don't.
Shut up, Google. We're just recovering. Perhaps this is the Fed spying on me. Anyways, we're just recovering jobs that we have lost before. And what the cocaine operation out of the Federal Reserve is successful at is increasing inflation, but not creating jobs. Give me one shred of evidence, one, that spending $120 billion every month at a minimum of buying bonds and buying mortgage-backed securities assets creates a single job. Give me one evidence that what the Fed is doing results in expansion and growth in the economy by creating new jobs. Give me one evidence. I'm still here waiting. So if the Fed decides not to taper now and keeping this facade going on for longer, perhaps all the way to September or October, here's what's going to happen. Remember this. Inflation in the beginning stages is actually good for the economy because it is accompanied by economic growth. And by the way, even economists, these zombie economists that you hear from on Bloomberg and CNBC, even economists cannot distinguish between growth and inflation. And they look at bond yields as a parameter for growth. You got to distinguish between growth and inflation. In the beginning stages, as inflation rises higher, it is accompanied by growth. Inflation goes higher, growth goes higher. Inflation goes higher, growth goes higher. But at some point, when inflation continues to grow higher or remains at an elevated level while growth slows down, we get the phenomena of stagflation. Why would we get that in the next few months, by the way? Remember the seasonality. The majority of jobs recovered, not created, recovered, or in the leisure and hospitality sectors of the market. The seasonality says that in August, September, the travel season slows down and you're not going to create more jobs in these sectors, meaning that perhaps the jobs report that we got on Friday is the peak and the pace of economic growth will continue to slow down from that point on. What if inflation continues to linger higher, Mr. Powell? Because you continue to print money out of thin air, propping up the market with over $120 billion every single month at a minimum, which will keep inflation higher. But there is no guarantee at that point that growth will accompany inflation higher. And let's hear from the great economist Milton Friedman about inflation.
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first and the good effects only come later. That's why it's so hard to persist with the cure.
And if inflation is just like alcoholism, then Jerome Powell is the bartender, and he's not going to stop until he gives you liver damage. And this is exactly what will happen to this economy. The beginning stages of inflation are great, but when we get to stagflation, the remedy will be extremely harsh. And it could cause a recession, if not multiple recessions, and therefore warnings all over the place. Mr. Powell, Federal Reserve, you need to start tapering now. And there's perhaps another side effect here that could be even more dangerous than stagflation, which is slowing down growth tremendously by shutting down the fiscal side of spending. Let's hear economist Mohammed Al-Aryan bringing up this point brilliantly, by the way.
Don't listen to the policymakers, listen to the C-suite in corporate America. Why is that so important?
Because if you just look at your macro models, they're not capturing structural change. And there's a lot of structural change going on in the economy. So listen to those driving. I completely agree with Rick. Business investment is going up. You have strong household demand. You have strong corporate demand. You have strong government demand. Do you really want to put the Fed on top of that? He spoke about a really important thing, which is resource misallocation, because the price signaling mechanism is distorted. That's not a good thing. We have excessive and I would say irresponsible risk-taking in some parts of the economy. That's not a good thing. We have a housing market that's pricing out Americans. That's not a good thing. So when I look at that, this is time for the Fed to start tapering. If it doesn't, we don't only risk the durable, inclusive, sustainable recovery, we also risk the Biden administration's agenda. That you already have people say, cut on fiscal. The economy is too hot. Actually, no, keep the fiscal because that's investing in physical and hopefully human infrastructure.
That's your argument in the Washington Post this morning, Mohammed. Just published the title, The Fed's Ultra-Loose Monetary Policy Could Hurt Both the Economy and Biden's Agenda.
And here it is, folks. The difference between fiscal and monetary spending is the following. Fiscal spending is tangible. The government spends on roads, bridges, hospitals, military, even handing people free money. That counts for something. Yes, it adds to the public debt, but who cares about the public debt right now? We're already drowning. We're going to end exactly like the Roman Empire. But until then, let's let the party keep rolling. The problem is, while the fiscal spending results in tangible results, the monetary spending adds to the public debt, but it doesn't result in tangible economic benefits. Magically, the monetary spending ends up making the rich richer by propping up real estate and stock prices. If the monetary spending goes out of whack, creating stagflation, voices will be raised, putting the blame on the Biden administration for the inflation problem and prompting the Biden administration to cut down on infrastructure spending, manufacturing, and reigniting this economy with real growth and real jobs. And this will be a tragedy. I look to no other than the Federal Reserve and their reckless policy to blame. If they stop right now, taper right now, you can avoid the scenario where you have to slam your foot on the brake and crash the stock market and the economy. If you taper now, you give the fiscal side the flexibility of being able to spend on infrastructure and creating real jobs and real growth. Lastly, before we move on to charts, I know you're waiting for the tickers. Here's a problem. We get a shortage of tickers. There are no new tickers today. But old viewers of this channel remember, last year I guided you like a baby to beat the stock market, from shifting to technology to the IWM when nobody wanted it. The reopening names, nobody wanted to invest in these names. And I told you, the opportunity is in the IWM and the reopening names, not the hot, sexy technology stocks. And then after that, I guided you through the inflation trade, that we are now concentrated on inflationary stocks. I gave you the Biden stocks. I gave you the transition to value stocks. And now the question is, what now? What is the theme now? Do we stick with the inflationary trade or do we do something else entirely different? Here's a food for thought. We're not going to do this right now because I want to see the market's reaction on Monday. Will the action in the US dollar and the bond market persists? And if it does, then on Monday we're going to talk about this and fill the data in this table, the different sectors of the market and how the economic outlook after the July's jobs report will impact each sector of the market. The impact is US dollar goes higher in anticipation of tapering. Likewise, yields go higher in anticipation of tapering. Economic growth is projected to slow down and inflation is projected to continue to rise higher. How does this dynamic impact each and every sector of the market? We're going to discuss all of that in details in tomorrow's video. But here's a little clue for you. Be careful of assuming, now that you saw the reaction in the bond market rising higher, yields rising higher, that the inflationary trade will be back in the front seat. Because this time around, we have tapering in the formula. Tapering pushes the US dollar value higher. If the US dollar rises higher, it will be bad for energy, materials, and industrials, all inflationary sectors of the market that have been outperforming year to date. So you got to be extremely picky here. If the dollar goes higher and yields go higher, then we're out of options here. I can see financials performing. I can see healthcare performing. But besides that, we're running out of space to hide. And that perhaps will lead us to a discussion that the next trade is cash. We'll talk tomorrow. But for now, we're moving on to the charts analysis, starting with the SPY 30 minutes chart. Looking at the chart from a candlestick pattern, there is nothing to see here. The chart has been zigzagging back and forth within a range. Or perhaps switching to a line chart with the defined range can give us a clue. On Friday, the chart broke above the trading range. Is this bullish or bearish? It is bullish. But you gotta be careful here of this being a bull trap. And the reason is, it could be a knee-jerk reaction in the market following the lead of the bond market. Yields spiking higher, closing above 1.28 basis points, matter of fact above 1.3 basis points. On surface, 1.3 is not a bad number. For technology, it doesn't scare the market at all. It doesn't scare growth. It doesn't scare anything. But if we go to 1.7, 1.8 rapidly, then we're going to have a problem in this market, a big one. The knee-jerk reaction was, yields going higher, let's rally the inflationary sectors of the market, specifically financials, and therefore the SPY trading higher. But can financials alone hold the market and prevent it from crashing or correcting due to a taper fear? Not at all. And therefore, watch out for this breakout becoming a bull trap. But for now, if you are a disciplined technical trader, you're not going to fight this one. You're not going to go on Friday, buy puts on the SPY when you have a break at a range, out of the consolidation range higher. Perhaps the warning signal is more evident in the daily chart, the continuous contract of the SPY. We are still trading within range, yes, above the last support level of 4,384.5. You can round that up to 4,385, but I'm still keeping the thumbs down here. And the reason is we have negative divergence in the RSI, we have negative divergence in the MACD indicator, and we have the seasonality. August, September, not good months for the market, folks. Yes, we can play the technicals. Looking at the candlestick pattern alone, it doesn't look bad at all. It looks like a bullish consolidation range, which will break higher. But you combine other information with the technicals, the likes of psychology, options trading, the volume, the momentum, the seasonality, and you gotta be extremely careful here. It will only take one scare to flush this market down. And it could be tapering. We'll see. What about the Qs? 30 minutes chart? We're looking at a line chart here because we have a trading channel with defined peaks and defined valleys. And as the trading goes on, the channel narrows as we anticipate the break out of the channel one way or the other. Looking at this chart alone, can you pick up any bearishness? Any signs for trouble? Of course not. It is still making higher lows and higher highs in the channel. There is no problem here at all from a 30 minutes chart perspective. We're trading well above the last support level of 365.5. No problems at all. Here's where the problem starts, or it has been going on for a while, matter of fact. The daily chart of the continuous contract of the NASDAQ. We're about to break 15,000, which is an important number to keep, a critical number to trade above. Breaking below 15,000 could open the floodgates, and it could happen overnight as I'm speaking right now. Furthermore, we have negative divergence in the RSI and a negative divergence in the MACD indicator. Now let's combine some fundamentals to the technicals. What happened in the bond market on Friday? Yields popping higher. Again, 1.3, no problem for technology or the NASDAQ at all. But the pace of the rise is concerning. If we're going to talk about tapering for real this time around, and we see yields reaching 1.4 tomorrow, 1.5. You're going to start to see a scare and a panic here in the NASDAQ, and this chart is looking like a prime suspect for a massive flush down to come. IWM, a little better than the SPY and the Qs, trading within range. We have solid support at 218. The chart played the bull flag higher, trading above 223, but closing below the highs by the end of the day, yet closing above 223. Can you be mad at the IWM here? Not really, because the reopening trade in leisure and hospitality sectors of the stock market, which happen to be in the IWM, the Russell 2000, outperformed on Friday on the heels of the non-farm payroll report. The question is, when we talk about the tide that lifts all boats, we can also talk about the tsunami that crashes all boats. Was the pop a knee-jerk reaction on Friday? In the IWM, are we going to reflect on what's really going on in the economy as we start trading for the new week? And if that is the case, if what I'm seeing is true, and the market is going to start to see it too, that the pace of economic growth will slow down, then even these reopening sectors of the market will also trade down because they're peaking. If that is the case, then the IWM will not be able to maintain a status as the only shining city on a hill amidst the darkness. And remember this, one of the biggest components of the Russell 2000 is the stock of AMC. Yes, the meme stock. AMC is reporting earnings on Monday. If that stock blows up, When we see apes getting slaughtered, we're going to have a bad day for the IWM. And it will be a double whammy if the reopening trade also underperforms. Dixie, US dollar, what's going on here? Again, the technicals were pointing to a flush down in the US dollar, a bear flag pattern, which will go and crack below 92 as support. But we continued in this channel to talk about the behavioral aspect of the chart, maintaining 92 as support and fighting for dear life, refusing to crack below 92. It is a show of strength, and when you combine the technicals, the behavioral chart analysis with the fundamentals, we came out to the conclusion that if the jobs report comes out too hot, triggering tapering fears, the US dollar will pop higher. It will not break below 92. And now we're seeing the US dollar popping higher, and it will probably trade above 93. This alone will create a panic in the market, both the commodities market and the stock market, because rising US dollar is not good for stocks, at least the majority of stocks. What about gold? What a beatdown. It is getting massacred as we speak right now. A massive flush down. And by the way, pay attention here. I told you before, if I had to lay a bet, and thankfully I did not, I would bet that gold will pop higher and the dollar would go down as the Fed indicate their intentions to refuse to taper. But the market is saying now, forget about the Fed. They will be forced to taper. You cannot ignore a hot report like we got on Friday. You cannot ignore the upcoming CPI report. If that comes out hot, goodbye. We're going to taper 1,000,000%, whether Powell likes it or not, whether he's waiting for Martians to recover their unemployment rate or not. And gold is the mature guy in the room. Gold does not make impulsive moves unless it is certain 100% of the direction it's going and what's going on with the macro outlook. When gold flushes down to this magnitude, down over 5% in a single day, this is a massive beating, and gold is now struggling to keep the support of the Fibonacci level of support around 1700. That tells me that gold analyzed all the data, all the output, the mature guy in the room, and decided tapering will happen, the US dollar will pop higher, and therefore, good night, Irene. We're going to dive down big. You see, the difference between inflation in the 1970s and inflation now is the issue of tapering was not even on the radar in the 1970s, and therefore inflation in the 1970s drove the value of the United States dollar down and the value of gold higher. This time around, we have tapering in the picture. Tapering pushes the US dollar higher. It will push the value of commodities, in this case gold, down. And I know what you're going to say. You're going to say, well, that means that inflation is not going to be here. We're actually going to go to deflation as the value of commodities go down. Perhaps, but remember this. Until the Fed actually tapers, it will continue to generate inflation across the economy. Notice that even as lumber prices, and lumber is the example that the transitory camp keeps bringing up over and over and over again. But even as lumber prices went down, the prices that consumers pay for lumber did not go down. The prices of homes continue to rise higher. Inflation is always a monetary phenomena. Last time around, you used the vacuum machine in the repo operation, and the Fed prevented inflation from being born to begin with. This time around, you can use all the vacuum machines in the world in the repo market. Once inflation is born, it's like a tornado. It has to work its course. And then, of course, after it's done, we can call it transitory, but the damage is evident. And that leads me to the chart of copper. Now we're worried about copper too, along with gold. If the US dollar pops higher, above 93, copper will flush down. This is a weekly chart of copper futures. They're breaking the trend, the bullish trend since the pandemic lows, the bottom, and we have a semi-head and shoulder formation here. We have a negative divergence on the RSI. This is a weekly chart, by the way, so we're seeing significant weakness here in copper. Combine delta with tapering, and perhaps copper prices will take a nosedive here. So be careful. I own the stock of Freeport-McMoran, but I'm buying plenty of puts here to protect my investment. And here it is, the chart of the day, the chart of the week, the 10-year Treasury yield. Popping higher, the double bottom, an important technical development. Double bottom and closing above 1.28 basis points. The assumption is yields will continue to pop higher. We have a descending trend line. Now, if that line is broken fast, meaning in 2-3 days, then we're going to have a problem in the market, specifically for the NASDAQ and the technology/growth names. They will crash fast and big if yields manage to recapture 1.4 within a week. 1.4 basis points within a week. This will be a significant development and it will freak the stock market. What about the TLT bond prices weekly chart? Do we have a reversal here? It's starting to look like it. It is not a reversal candle yet, but it is an indicator for significant weakness because this week's candle failed to make a higher high. As a matter of fact, it closed at the lows of the week, closing below the last 2 weeks' worth of activities. If you follow the book, this is the definition of a reversal candle, but without a confirmation, what good is it? And perhaps the confirmation will come as soon as Monday. A reversal in the TLT. We will see a flush down in the TLT and a massive pop in yields. What about the VIX? What's going on here? We talked about the first knock, the second one at the door of 20. If the VIX trades above 20, we're going to have a major problem in the stock market. What happened on Friday? The VIX flushing down, closing at the lows of the day and breaking the technicals, the rhythm of the technicals. We're talking about the MACD and the RSI. You see the RSI, the MACD with a certain rhythm, and that rhythm was broken on Friday. A massive flush down in the VIX. You see a steep flush down in both indicators, the MACD and the RSI. This is usually a contrarian indicator. Pay attention now. When we talk about a contrarian indicator, it means that this is a bull trap when we talk about market bulls, because this behavior could be a coil spring being pushed down only to be released with a massive pop higher. And this is exactly what I'm watching for in the VIX's chart this upcoming week. We have a gap and the chart could go down all the way to close the gap and then spring back into action. But the assumption is Friday's activities, we have seen many knee-jerk reactions, and these knee-jerk reactions will be corrected as we start trading for the new week. Was the flush down in the VIX a knee-jerk reaction? I certainly think so. But again, don't listen to me because the likelihood is you're going to lose a lot of money. What about Apple 30 minutes chart? Nothing new here, trading within range, 145 as support, 150 as resistance. Apple is the market, and the market is Apple. If Apple goes down, so will the market. Therefore, the importance of the level of 145 as support becomes extremely critical. If Apple breaks 145, it will be an ominous signal for the stock of Apple, but also the stock market in general, specifically the NASDAQ and the big cap technology and growth stocks. 145. Watch 145. What about Tesla? What's going on here? 30 minutes chart. We talked about the knocking on the resistance, 720, over and over and over again, as an indicator of strength. But we know that this stock moves solely based on the options market. Nobody's buying Tesla legitimately at these levels. They're buying it via call options. What happened on Friday? A pullback and an absence of knocking at 720. What does that mean? Did the chart fail? Did the chart get rejected from 720? The answer is not really. What can you do as a trader looking at this chart? The answer is nothing. If you are a bull looking out to buy some calls, betting on a break higher above 720, what I would say is wait for the break higher and then buy the call options. There is still going to be plenty of meat left on the bone for you to chew on because breaking above 720 will ignite a massive rally in the name. If you are a bear eager to bet against the souffle by buying puts, you gotta wait until the chart goes down to the gap, failing to rebound and closing below 679. This will be the signal for you to buy puts all the way to a minimum destination of 629. What about tulips? BTC, what's going on here? Breaking above the consolidation range once and for all. The shorties, the technical traders, covered and bought BTC below 30,000. And they took the ride higher all the way to the resistance level of 42,000. They took profits at that level and we saw the sell-off. And it now became on the hands of the laser beams, the true believers in tulips, and in this case Bitcoin, to buy the dip and push it above 42,000. Guess what? The laser beam showed up, they bought BTC, and now it is trading above 42,000. The ultimate test for Bitcoin is perhaps coming in the next few days. Remember in the intro of the video, I showed you every sector of the market and the impact on every sector of the market. We did not discuss the impact. I left the chart blank for now, but I outlined the outlook. of upcoming tapering, taking the value of the US dollar higher, bond yields higher, inflation higher, but the pace of economic growth down. Will this combination be bad for the stock market as we search for the next trade? What's after the inflationary trade? What's after the reopening trade? Where do we park our money right now? Well, if the US dollar is going to rise higher, yields popping higher, growth going down, inflation rising higher, then we're going to run out of options here. You're either going to have financials, maybe healthcare outperforming. But what if this combination is the ideal environment for tulips? And tulips is the next trade. You park your money in tulips when there's uncertainty in the market. If Bitcoin holds that test and continues to rise higher amidst the volatility in the stock market and the uncertainty of upcoming tapering, boy, that will be a huge tailwind for cryptos in general. Not just Bitcoin. Because if the market goes down but Bitcoin trades higher, a lot of traders, a lot of investors will start parking cash in Bitcoin, and this will boost the price of BTC significantly higher. Moving on to AMC, what about the weekly chart of the name? Not looking good at all. This is a line chart. It took a massive nosedive, and the technical indicators, the RSI, the MACD, all turning negative. We know what to expect from AMC's earnings on Monday. They're going to be bad. They're going to show no recovery at all. People have shifted habits, perhaps permanently, to watch movies at home, regardless of the reopening. So it will be a bad report for AMC. But we already know that. Now we're anticipating the element of surprise. Can the management of AMC produce any surprise, any piece of news that could trigger short covering in the name? And if that is the case, then the apes will rejoice and the chart will defy the technicals. I'd love to hear from you, specifically the ape community. What would be the surprise out of the report from AMC? What would be the pleasant surprise that could trigger short covering? I'd love to hear from you. And with that, ladies and gentlemen, we're moving on to the conclusion of this video. What do we have on the economic calendar this week? On Monday, we have jobs openings. This is a great indicator for wage inflation. And then on Tuesday, August 10th, we have the small business index and the unit labor cost. This will be important for inflation as well. And then we have Wednesday, August 11th, the big one. We got the CPI. Will it seal the deal on tapering? This is exactly what the market will be watching for. Thursday, August 12th, we have, per usual, the weekly jobless claims, in addition to the PPI, the Producer Price Index. Lastly, on Friday, we have the Import Price Index and the University of Michigan Consumer Sentiment Index. Folks, this week will be extremely critical for the future of the market all the way till the end of the year and perhaps beyond. If the inflation numbers come out hot, then the base effect argument goes out of the window, flushed down the toilet. And now we have inflation rising higher significantly. And we have a hot jobs report. We're going to have tremendous pressure on the Federal Reserve to start to taper. Perhaps we haven't seen tapering fears before. That was just a mere reaction in the bond market due to technicals, Delta, who knows? But the real tapering fear and taper tantrum is about to start this week, this upcoming week. We'll see. Lastly, what about the earnings calendar? On Monday, we have BioNTech, Dyson, AMC, and Squarespace. Tuesday, we have SoftBank, aka the devil, Coinbase, Weight Watcher, WW, no fat shaming intended, by the way. And then we have Poshmark, whatever that is. Wednesday, we have Wendy's, Bumble, and eBay. Thursday, we have Palantir, that's another cult. And then we have Disney, Airbnb, DoorDash, and SoFi. And with that, ladies and gentlemen, once again, thank you for watching. This is all I got for you for tonight, and I will talk to you again tomorrow.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.